Yeah, I think you really saw two key things happening. So first, on the top line, our share gains continued to manifest and really accelerate, and that led to that 5% top line, 6%, adjusting for the German business comp. So that's pretty exciting for us. And then what you saw is a really nice flow through of that revenue to adjusted EBITDA, crossing that 200 mark, 205 of adjusted EBITDA. And I think that really shows the strength of the model and the efficiency of the cost takeouts over the last several years. So to have the nice revenue momentum, the share gains paired with that cost efficiency, for many quarters, we said you should see that really significant flow through when that happens. And indeed, that manifested in the second quarter.
Kate, whenever I ask someone about the stock price and it doesn't look great, they always say, well, we're focused on doing business here and we don't care about the shares. But you got to care about them on some level, especially as a CFO. So, you've had an incredible year. Year to date, you're up like 66%. But if I bring the chart out to, the COVID highs, you still have a long way to get back there. I think you're down 70 some percent from your 2021 highs. Is that going to happen, you think, at Wayfair, or was that just, like la land levels in the pandemic?
Well, now we're focused on operating the business. But let me unpack it a little bit for you, because the reason you probably hear that answer is, at the end of the day, we do believe that the valuation and sort of where investors see the business should, over the long run, follow the performance that we drive here at the company. And so our focus actually really is on how do we continue to take share, and how do we continue to flow through that revenue into adjusted EBITDA dollars, into free cash flow growth, and into a metric that we look at where we call owner's earnings, which is that EBITDA less our CapEx expense less our stock-based compensation. And we do want to continue to build on that over time, and we think we can. And as we continue to grow the top line, as we continue to grow those adjusted EBITDA dollars, I firmly believe that the valuation will follow.
But revenue, just
go ahead.
Can it get back to that? Or was that just like everybody locked in at home and the government throwing money at American citizens? Is that why revenue climbed so high during the pandemic? Or can you get back to that level?
Yeah, so if you think about the category itself, obviously the category itself had a very unique period during the pandemic where growth accelerated in the category in 2020 and into 2021. The category has had significant pullback since then in 22, 23, 24, and even still a bit in 25. We would say we think the category is sort of flat to slightly down, low single digits in the past quarter. So the category is still under quite a bit of pressure. Can the category return to a normalized level of growth? Of course, right? The category in a normalized period grows, sort of 3 to 4%, the overall home goods category. And we do believe that we can return to double-digit growth over time, where we significantly outpace the category. That's what we did for the majority of our history, significantly preceding the pandemic. And it's what we expect to do, as the category returns to normalization. So, can we ever get to the revenue that we had during the pandemic? Absolutely. We're quite confident in our ability to do that.
You mentioned earlier about cost efficiencies of the model. What specifically?
Yeah, so over the last few years, we've been quite focused on a few things. One has been improving our overall sort of total overhead cost structure. That manifests in that SOTG&A line in the P&L. And I would think about that as really our fixed cost basis. The majority of that line is labor. And so we have had a number of restructurings where we've reduced labor cost. And that has shown up in that line. And we've said that where that line is right now, at that $360 to $370 million point, it should be able to hold there for some time, even as we continue to grow the top line, as we get ongoing efficiency from labor, and as we, sort of continue to see the benefits of some of the growth investments that we've made. So that's one big area of cost management. We also have been improving our sort of structural gross margin. So we took out, costs in our supply chain, and that's really helped our gross margin. And we've added some supplier services like supplier advertising, which have helped improve that gross margin as well. We've reinvested, a significant portion of that back in the customer experience in the form of price, in the form of delivery experience. And so we've held that gross margin at 30 to 31, but structurally we've been able to drive it higher and instead give it back to the consumer and then flow that through and ultimately, cover off on that fixed cost basis.
I wonder how you deal with tariffs because you have so many suppliers, but furniture making in the United States of America is far from its peak these days. So, do you get suppliers to kind of eat that? Are you taking some of it into your margin, and how much are you passing on to the consumer?
Yeah, what we talked about actually, in May, when Carol and I spoke before, was that we thought the benefits of our marketplace model would help us manage the tariffs. And that's because we are able, as you point out, Matt, we source from over 20,000 suppliers, right? So we were able to have a very wide range of goods with suppliers from all over the world, including some from the US. And we're able to then position within a given class or category, say like this chair that I'm sitting on now, we're able to position the products that we believe are best for the consumer. So most price competitive, can get to her quickly, are high quality. We're able to position that first in the sort order among many very similar products. So if a product gets relatively more expensive, other products will then move up within the sort order so the consumer is able to see the product that is most price competitive. And that means there's a tension within the marketplace where suppliers actually want to maintain their price competitiveness. They do not want to lose that volume, particularly in a category, as we spoke about earlier, that's been under pressure for some time. And you're seeing that pan out. So what we said on the call this morning was, on a like-for-like basis, for the products that are on those first few pages of the sort order, when you search for, sort of lounge chair, you're going to continue to see, and you are seeing, prices relatively stable on those first few pages. And that means that the products that the consumers are buying, they're not yet seeing, pricing changes flow through. And I do think that's due to the, breadth of suppliers that we work with. And the competitive nature of the marketplace.
We are talking with Kate Gulliver. She's the Chief Financial Officer of Wayfair, joining us from Boston. Hey, Kate, so what do you know about the type of shopping that consumers are doing? When they're buying, are they buying more items? Are they buying fewer items? Give us some idea in terms of some of the trends that you're seeing in terms of the actual shopping going on.
Yeah, it's a great question. So when we think about our average order value, or AOV, that's really comprised of three different pieces. One is like-for-like pricing, like we just spoke about. One is items per order, to the question you just asked. And then last piece is mix. And we actually are seeing a little bit movement on items per order and mix. So on items per order, we're seeing a little bit of increase, nothing major, but sort of moderate. But where we're really seeing momentum is on mix. And what we mean there is that we're seeing mixing in brands of ours that are actually sort of higher value. So Paragold, which is our highest end, our luxury brand, we're seeing ongoing really nice momentum there. Our specialty retail brands, so All Modern, Joss & Main, Birch Lane, again, these operate a little bit above that mass segment that the Wayfair.com business operates at. Those are also seeing nice momentum. And then our B2B business, where we sell, to professionals and the trade, we're seeing nice momentum there. All of these are much higher ticket values than the sort of core Wayfair.com business. The other thing I'd add is, we're obviously newer to the physical retail game. We have our first sort of large format Wayfair store opened a little over a year ago. And we're seeing nice momentum in categories like storage and org and small kitchen accessories in the physical space as well.
Do you want to keep continuing to add in terms of the physical stores? I know you guys have some more expansion going on.
Yeah, no, great question. We're thrilled with the performance of that Chicago store. Really two key things that we see there. One is the halo effect, so the sales that we get in the surrounding region from having the store there. And then two, within the store, we're seeing nice momentum in categories that, maybe sort of underpunch a little bit online, like storage and order, kitchen accessories, small appliances, that kind of thing. And so as we look at it, we see significant opportunity from a growth perspective in expanding stores. We've actually announced 3 additional leases. 2 will open in 2026, one in Atlanta and one in Denver. That's our first store in sort of the Mountain West region, so we're very excited about that. And then early 27, we have a store opening in Yonkers, New York. So you can see us starting to build some of the momentum here. That'll be a little closer to home for you guys.
Yeah. Hey, Kate, I wonder about your view on rates because, maybe if you're buying just one chair or a side table, you can afford that. But I'm sure a lot of Americans are putting stuff on a plan or borrowing money. And today the 10-year is pretty low, but the idea, I think, is that rates are going to tend to go up from here. What's your view?
Just got about 30 seconds, Kate.
Yeah, you know, I would actually say in our business, actually, the average order size is only around $300. So, well, you know, rates have an impact on the consumer overall in terms of the housing market. In terms of her purchasing with us, it's, you know, largely not financed.